Thanks so much for tuning into BQ Conversations. So, well, one thing that has befuddled most experts has been oil. From the nadir that it reached sometime when demand saw massive destruction due to the coronavirus-induced lockdowns, to the meteoric rise hitting, well, not dramatically high levels, but a level of $50 to a barrel, which not many people envisaged some time back. It's been a story that has been like very few others. The question is, after recouping a large portion of its losses in the year 2020, what is in store for 2021? And of course, what will happen to the tug of war between the virus induced lockdowns versus the vaccination induced opening up? Let's put those questions to Dr. Kang Wu. He's head of global demand and Asia analytics at S&P Global Platts. Joins us right now on the show. Dr. Wu, thank you so much for joining in. Hope all is safe with you. How do you analyze the near term for crude?
Yeah, the oil market, indeed, as you mentioned, that is really torn between the good news about the vaccine development and also the danger of second wave of pandemic. I think most recently, we have been sort of influenced by this the danger of the second wave of pandemic for quite some time. So when the news about the vaccine development and potential application, potential use came up, is really the good news for the market. We do have some other reasons, other news in the market that has boosted the prices. So in a way, the demand is still struggling on the ground, but there is a hope that in 2021, when the vaccine are more widely and massively applied, demand will recover. The only question is to what extent and how much the recovery will be.
But your note clearly suggested that even if demand recovers, it won't be in quarter 1. So therefore, my question to you is in the very near term, if indeed there are these virus-induced lockdowns, Germany, Netherlands, New York City might go into the lockdown. We're hearing a couple of other nations also speak about this. Could there be a downward pressure on crude prices from the levels that they are at, led by lower demand?
Precisely, on the fundamentals front, that is exactly what was happening now. The demand is not improving drastically because of the peak levels of infection and the corresponding policies by different countries to combat the rising or peak level additions every day. That's why fundamentally, before things getting better this year, we continue to be bearish. However, the prices right now, there are some other factors, but on demand, we'll see our view, S&P Global Platts view is for December this month and first quarter next year, the demand will be the recovery will be weak, but the recovery of the demand will pick up in the second quarter and particularly towards the end of the year. So you can see from the chart that that's how we see next year. We are looking at 6.5 million barrels per day of demand recovery. Of course, on the back of 8.7 million barrels decline this year.
I'm guessing this is normalized demand, and you obviously must be difficult to factor in what would happen to the variability because of the lockdowns that are starting to emerge, because we don't even know the extent of the lockdowns, how severe they are, and the length of the lockdowns, because it's varying across countries.
Very good question. Actually, we are torn between the increasing infections and lockdowns and the vaccine development. So our base case view incorporated the most likely sort of development, which means we continue to have a second wave in individual countries, but not globally, not global pandemic, and yes, we will have a reasonably well developed vaccines, but not like super good. So the alternative case could be super fast development of vaccines versus the full second wave pandemic. Those are alternative cases. So basically, it's already incorporated elements of that. It's most likely case we see next year, but obviously not the only case, right? It could happen the other way. So there is a still danger, and there is a hope for next year, or more hope.
Some of the larger gasoline consuming countries, if you will, are not necessarily going into full-blown lockdowns. Is that a big factor? And would you reckon that if indeed, I mean, India, for example, I'm not saying it's the largest, but it's a large consumer any which ways, and we are actually seeing the number of cases come off every single day. For example, on December 15th, we've logged in probably the lowest cases in a really long time. So is that a bit of a support to prices, even if they were to drift down from here? And what's your sense, of course, on what could happen to pricing in the near term?
Right. You precisely point to what we call East versus West. The East is led by China and India. China has long recovered already, right, in terms of many elements. India is recovering. November demand, although year-on-year was down because of last year's high base, month-on-month was better. So December is getting stronger. So India and China represent East, and entire Asia is leading the recovery. So the story about the gasoline, more gasoline use is happening here. But in the West, of course, earlier was Western Europe, very kind of a critical situation. And now Western Europe is getting better in terms of direction of infections, but US is getting much worse. So the US and Western Europe are the one that cap the gasoline demand. So that is a mixture, it's a mixture of the mixed bag in a way. So gasoline is more like balanced. So gradually going forward, gas oil is a little bit better because of industrial support of the developing countries and some developed countries as well. So that sustained the recovery. But the seasonal and the series of the weather condition, meaning that more chances of getting infected, preventing oil demand from going up too fast in Q1. So in Q2, with the vaccine, things will getting better.
Okay. Dr. Wu, one final question. We've spoken about demand at length. Difficult to predict that one for sure. And of course, it's very difficult to predict supply in case of oil as well. But can anything disrupt supply meaningfully to impact prices, or you don't reckon that OPEC and OPEC Plus have the cards or have the wherewithal to be able to call the shots currently?
Yeah, very much so. The prices are determined by other than demand is supply and the stock. The inventory change is very important. On the supply side, of course, because of the relatively low prices, we talk about $45 or under 50. So economic impact on non-OPEC is very obvious. So their production, including the US, has been capped. For that matter, OPEC Plus plays a much better role, right? A much more important role. So their decision to increase or decrease the production or to manage the price flow, the price levels are important. We do see that OPEC will respond to the increasing demand to balance the market. However, there's some risk as well. There's some upside risk, right? In terms of the some Iranian volumes may be returning, not a lot for next year. Libya is already on the way up, and Venezuela may be stabilized. So that will add on the upside. And longer years beyond 2021, there'll be more upside risk on the supply side. In the meantime, of course, U.S. shale could come back if prices of the Brent stay above $50 sustained, in a positional way. Then U.S. shale may stop declining and could come back to the market. There's some downside risk too, but right now there's adequate supply overall, and the only question is how they're going to manage it.
Thank you so much for throwing your perspective on all of those, Dr. Wu. Really appreciate your time.
Thank you very much for having me.
The view from the from S&P Global Platts, believe that there is, if at all, some bit of downward or downside risks to crude oil prices, led predominantly by lower demand, and supply may not be as big a factor as otherwise it usually is. Thanks so much for tuning into this conversation.